This week on Wealth Track, swimming against the tide with deep value investor Robert Kleinschmidt. The Toqueville Fund's longtime portfolio manager finds his best investments in rough seas others flee. His contrarian ideas are next, exclusively on Consuelo Mack Wealth Track. I began the interview by asking Kleinschmidt why commodity prices, above all other indicators, are key to understanding the global economy and markets.
Well, so there used to be something called Dr. Copper, which you paid attention to copper.
Yes.
But the reason that I think commodity prices are much more illustrative is that they're objective. They're not subject to political spin. They're not subject to a political agenda. So we all know, for example, that we shouldn't trust China's numbers, and yet people do. They report them, they listen to them, and have over the course of the past several years. We all know that we can't trust Greece's numbers. We all know that we can't trust Argentina's numbers. But the truth is you can't trust any government numbers. There's a spin and an agenda associated with all of them. The very fact that the government measures something is an indication for them to do something about it. So it's part of the agenda is to grow the size of government. So the government produces the kind of numbers to the extent that they can, which most favor their agenda. And in political years, we're used to these, the October surprise, and unemployment numbers are better than you think, and all that. So the point is, there's too much going on in government numbers to be completely reliable. They're not completely unreliable, but they're not completely reliable. Whereas commodity prices, when they all go in one direction for as long a period of time as the commodity prices have been in this particular cycle, if you're paying attention, you should realize something is going on.
Right, so what is going on?
Well, it's actually more than 18 months. I really do think that the commodity prices, by and large, peaked late 2011 and 2012. So we had this long period where I think the commodity prices were telling investors is that the world economy was slowing down and possibly even shrinking.
And is it primarily a China story, which is what a lot of people who are analyzing commodities say it's China?
It's certainly, China is not China's important.
Right.
It's not the whole story. And but it is true that China's growth, the growth in China's economy represented a disproportionate amount of the world growth.
Yes.
So its economy was smaller than the growth of its economy was relative to the rest of the world's growth. So it did have a big impact on that, and it had a big impact in the way that they grew their economy. But it was hardly the whole story. There are plenty of other economies around the world, and had those economies been booming, then prices would not have collapsed to the extent that they have.
Right.
But they certainly did. But my point is that rather than look at what these relatively objective prices were saying, and by the way, until we invented national accounts, until the sort of mid-20th century, early 20th century, economists always looked at prices as a proxy for what was going on in the economy. So this is not new stuff, this is old stuff.
Right.
But it's old sort of reliable stuff, imprecise to be sure, but reliable, as opposed to relying on whatever government spin there is to make the numbers look better than they are, et cetera. So I think that this disconnect that has been going on for the last several months, maybe the last couple of years or so, began to surface in the last year amongst most stocks. And there were only a few stocks that were immune from it. And then in the beginning weeks of this year, I think you've started to see capitulation across the board with respect to even to the names that had formerly done so well.
And why do you think that happened? What was it that triggered it in the beginning of this year?
Animal spirits, I suppose, but the point is, you can't divorce yourself from you can divorce yourself from reality for only so long. Mm-hmm. I don't know exactly what triggered it.
Right.
Maybe it was some news out of China. Maybe it was the Fed finally raising their rates. But all of a sudden, people looked at things that they hadn't been looking at before, and came to the conclusion that things were worse than what they had previously assumed.
How bad are things? I mean, when you're talking about commodity prices have been reflecting a slowdown in the global economy for several years.
Right.
The market's just kind of catching up to that now.
Well, ironically, I'm turning sort of bullish. Right? It took a long time for stocks to catch up, but when they catch up quickly. Mm-hmm. Markets are moved by greed and fear. Fear is stronger than greed. Greed, so the markets go up, it takes a long time for markets to go up, but they can come down fairly quickly.
Which they have done.
Which they have done.